Hey there, I'm Ryan Chan, the CEO and founder of UpKeep. Have you ever wondered how to track the depreciation of your assets and what it means for your business? Well, in today's video, we'll be exploring the world of asset depreciation, breaking down key terms and formulas, and giving you practical tips to get a handle on it. Plus, we'll dig into how asset depreciation can impact your maintenance planning. So, if you're part of a maintenance or operations team, this video is made for you. Let's get started. Let's dive into the world of asset depreciation. To track asset depreciation, you'll need to understand its annual depreciation. Here's a quick formula to help you out. Subtract the salvage value from the initial cost and then divide that by the useful life of the asset. This gives you the annual depreciation. But what exactly is the useful life of an asset? Well, the useful life is the period of time during which the asset is expected to remain in profitable service. This is a key factor in calculating straight-line depreciation. To determine the useful life of an asset, you could rely on your own experience with that asset, use data provided by the manufacturer, or even refer to the IRS's property classes in Appendix B of Publication 946. Although the IRS publication might seem a bit complex, it can help you factor tax benefits into your maintenance decisions. If you can no longer claim an asset's depreciation as a business expense on your taxes, it might not be worth it to perform major repairs on it. Now, let's talk about the initial and the salvage values. These are also crucial in tracking asset depreciation. The initial value is what you paid for the asset, and the salvage value is the amount you'd be able to get for it if you sold it. To calculate depreciation, you'll need the initial and salvage values and the useful life of the asset. Using the formula we discussed earlier, subtract the salvage value from the initial cost and divide by the useful life. This gives you the annual depreciation. Let's break it down with an example. Suppose you have an asset that cost you $40,000, has a salvage value of $15,000, and has a useful life of 10 years. Plug these values into the formula, and you get an annual depreciation of $2,500. This means that each year, your asset will depreciate by $2,500. If you've had it for 4 years, multiply $2,500 by 4 to get $10,000. In terms of maintenance planning, your asset is now worth $10,000 less than it was when it was new, or $30,000. If repairs would cost more than that, it might be more cost-effective to replace it. You might be wondering how often you should calculate asset depreciation. Well, you probably don't want to calculate depreciation for every asset every time it needs major repairs. So I'd suggest 2 tracking methods. First, you could calculate the values every time you do taxes and keep those values readily at hand. Alternatively, you could use asset management software to track it for you. If you go with the second method, you just plug the asset's cost, useful life, and salvage value into the program, and it will automatically calculate it for you. This makes maintenance planning a bit easier since you'll always have the depreciated value available at your fingertips. And that brings us to the end of our video. We've explored the concept of asset depreciation, its key terms, and how to calculate it. We've also discussed how it can impact your maintenance planning. Thank you so much for watching. If you found this video helpful, don't forget to subscribe to our channel for more informative content. For more resources and tools to help your maintenance and reliability teams be more successful, visit our website at upkeep.com. We look forward to seeing you again in our next video.